Welcome to the Chamber Music Mindset. I am your host, Anna Rathbun. I am back. I took a week off, but I am back in the middle of December when the markets have been a little bit jittery. And certainly I will talk about the Fed decision from last week. Now, before I start, I have to remind you the normal disclaimer, which is that none of what you hear in this video is investment advice. Everything is for informational purposes only, and it is all my opinion. Okay, market update. While I was gone, the markets were down. Maybe I shouldn't go away. Okay, let me look at the numbers here. The S&P 500 index last week returned negative 0.38%. Russell 2000 returned negative 2.29%. So yes, there was a lot of nervousness in the markets where riskier assets like small cap stocks sold off more than what is considered to be more stable large cap stocks. Now, and it's happening this week as well. I am recording on Wednesday evening, Monday and Tuesday. The market sort of starts up because, the previous day, maybe there was a sell-off and some of the buyers are coming in. In the middle of the trading day, it is actually some of that buoyancy is losing steam, right? So we've been ending the day in the red, both Monday and Tuesday, and actually today as well. And that's sort of the story for last week as well. And what is providing that kind of negative sentiment is really all around tech. Remember the last 2 years or so when tech was the thing that was driving everything up? And now it seems to me that tech is influencing the market sentiment in the other direction, and a lot of things are selling off. And certainly tech stocks and AI related stocks are selling off more than others. Okay, so tech pressure is driving everything. So I want to talk about two things today, tech and AI. What is going on? So that is sort of related to the market update, but it is one of our topics for today is an update on that. And then in the next segment, I'm going to talk about interest rates because while I was gone, the Fed did lower rates by 25 basis points, what that means, as well as some of the data we got that I think a lot of people wish the Fed had access to this information before they made the decision. But nevertheless, we got the jobs numbers this week. And so I'll talk about that in the second section. Okay, so let's talk about tech and AI. Let me give you an example or a picture of what this has felt like. So back in October, when the markets were still hitting all-time highs, NVIDIA was also hitting a high. Since that high in October until about today or yesterday, NVIDIA has lost more than 15%. I think if you want to be more accurate, it's around 17%. That's a lot of market capitalization loss. That's a lot to lose, right? So the question is, where is this coming from? It's not, you could argue that it's a bubble popping. Okay. You could say that about any stock that loses value, right? So, and not every stock is a bubble. What is happening here is something that's very natural in a free market economy. Remember, I think it was like 2 or 3 weeks ago, a few weeks ago, I talked about a pivotal turning point in the AI race in the United States, which is that Google came out with two bits of news. One was that it unveiled Gemini 3, which was excellent. In fact, I was away last week planning my trip. I actually was very curious about Google Gemini 3. So I actually used Google Gemini 3 for a lot of my planning. And believe it or not, it was an excellent planner. So, it hallucinated sometimes, but I was very surprised. So Google Gemini 3 was one, and the other one was TPU, which is a computer chip that can actually compete with NVIDIA. In fact, Google said that they were actually using their own TPU to build this thing. And a lot of other companies started to sign up. So one of the companies was Meta. I believe Anthropic also signed up to use Google's TPUs. So suddenly, there's a competitor for NVIDIA, right? This isn't a bubble. This is a natural evolution of what happens in a competitive market. You have new entrants. Now, anybody who sets up a company, this is unlike the 90s, tech bubble where internet bubble where anybody who knew how to program can actually, log on and start to code in HTML and later Java. That's not what this is, right? If you're a small company, then you don't have the resources to do all of this, right? You have to be able to write big checks. So here is Google, a gigantic company, writing big checks, doing research and development, and actually coming up with a competitive product. It's also competitive with OpenAI because Gemini 3 is not a chip. It's an actual chatbot, right? So it actually competes with OpenAI. So the infrastructure of AI that we had gotten to know for so long, NVIDIA and OpenAI, Google came in and disrupted that, right? That relationship and what we believed was the train was heading in this direction. Google said, surprise, no, actually the train now has options, right? So I think this is a really healthy thing in a market economy. As an investor, this is very, very exciting, right? And just as a watcher of tech, it's really exciting to see the innovation and just how quickly the innovation is happening. It's all very, very exciting. Okay, so the disruption for NVIDIA, so that 17% fall totally makes sense. I don't view it as a bubble popping. I view it as, oh, now they've got a competitor, right? One more thing that goes to show diversification is really important, because if you put all your chip eggs in one basket in NVIDIA, I mean, who knew that Google was going to be doing this, right? That it was going to be coming out with a TPU and actually prove that it could be used to program, AI. So, hope you had Google. I mean, you just never know, right? And especially with AI, a lot of players that you would not even have expected are coming out. And they're actually, fiercely developing things. So there's going to be a lot of surprises in the coming years. That is what I'm thinking. Now, the question is, why is everything else selling off? Part of it is the disruption. Oh, we didn't expect this. And secondly, there's a bit of a domino effect here. So I'm going to use a few examples. Oracle. So back in October, I believe, in one of the interviews I did, I was asked about Oracle. Now, Oracle was this company from the 90s, and hadn't really heard of it as much. The Magnificent Seven sort of became household names. But Oracle sort of made a comeback by talking about building data centers and cloud infrastructure. And it actually had gotten into a contract or agreement with OpenAI to support it. Wonderful. Oracle, I think the stock went up in double digits, and I don't mean in the teens. I can't remember the exact number, but the markets definitely rewarded them for it. Now, last week, Oracle came out and said, actually, we're going to be delayed until 2028. That kind of a delay, it was the markets did not take it very well. And the delay really isn't because Oracle can't do it or AI is a bubble. It's because of supply constraints. We've talked about this before. There are true supply constraints because you actually need physical things to build these things, to build cloud infrastructure. And when those physical things are in shortage, you just can't build it as fast as you want. There are certain limitations or limiting factors. Okay. The other thing is, some analysts project, I think, if I were to average it out, just under 30% of Oracle's revenue is projected to be coming from OpenAI by 2027, 2028. That's huge concentration of revenue on just one organization, right? And if you If you were putting all your eggs in one basket and then suddenly there's another option, of course the markets are not going to like that, right? For Oracle, future of Oracle. So that there was definitely a domino effect of Google coming in with this news on Oracle as well. There's also worries about circularity of cash flow. This has been a conversation about AI that's existed for a long time now. I haven't addressed it here because there's so many other things to talk about, but also I want to keep these things not too lengthy. But I will address it today because it is getting, in some ways, more complicated. So I'll give you an example. And just know that it's happening at a much larger scale. So Amazon and OpenAI, they kind of invest in each other. So Amazon invests in OpenAI, OpenAI invests in Amazon. OpenAI also does this with other companies, and other companies do it with OpenAI. So there's a lot of reciprocal investing that's going on. NVIDIA does the same. So if you're Amazon and you're investing in AI, that means if you think about the mechanics of money, the money is going into OpenAI, which then you can imagine that OpenAI is going to then use that cash to buy services from Amazon, right? So if from an Amazon's point of view, the question, or investor point of view for Amazon, the question is, if you have great earnings and your sales is great, is it organically coming from outside into your company, or is part of that the investment that you've made in OpenAI that is being used to buy your own services? Are you buying your own services with OpenAI in the middle? So that's an example. And the web is pretty complex. Okay, a lot of these big AI companies are doing this. Another thing is NVIDIA too. NVIDIA investing in OpenAI, same thing. NVIDIA, your sales are great. How much of that is just purely outside money and how much of it was your own? You kind of have to ask these questions. And so, the public that's paying attention to tech, we've been asking these questions. I've been watching this happen more and more, and the web of these relationships get more complex. And of course, because of this, investors also get nervous because it's difficult to keep track of who's investing in whom and wondering about how much of that is actually being used to buy those services from the investor. No one really knows, but it does make investors nervous. And when things get a little bit hairy and there's a sell-off sentiment, these things can come into play to really fuel it. And I think that is partly what's happening here. Now, one thing to note about tech and AI, one of the differences I have made in the past, maybe not in this video, but certainly in my interviews, there is a difference between the 90s tech bubble and this AI run, I will say. And there are many differences, but one I'll point out today is what I said earlier. During the tech bubble in the late 90s, the cost of entry wasn't very high. If you were a startup, you could create a website. If you were a startup, you could be a developer and you could code things. And coding was not as complex, right? So you could have very little resources and do this in your parents' garage. Whereas building capacity to build AI infrastructure is not something I can do in my garage. It takes a large check. And the companies that have a large check are by nature mega cap companies like Google. OpenAI isn't a public company, but they have a backing of a lot of investors, right? So it's actually really massive. Same thing with Amazon, large companies. NVIDIA became a huge company, right? And this specialty, and the specialty meaning like the knowledge base to start this and get into it and know exactly what it takes to build these things, the barrier is so high that in order to build this out, these large companies have to be involved. Okay, unless you're just like a large institutional investor who wants to put all of the eggs in one basket. I don't think anybody wants to do that. So these large names have to be involved. And so it's sort of become this big club of mega cap companies and large clubs and large private players, investment players in the space. That's not good or bad. That's just what it is. And it sort of is required, except in the software space. In the software space, it's sort of like the 90s, where if you are gifted in AI coding, you could do it. You could do it from your parents' garage. You can do it from the comfort of your living room. You can do it. Now, not everyone's going to be successful. Some are going to, there's going to be a lot of trials and errors, and that is the nature of being an entrepreneur and creating something brand new. Okay, this is innovation. There's a lot of failures before you have a success, but that is something you can do. The barrier to entry is just up here. You just have to know how to do it. And maybe like having a laptop that can actually handle that amount of processing, right? And access to. Well, maybe it's not super low. But what I'm trying to say is there are a lot of players in the space working on the software, and that is very, very exciting. And while we've been worried about an AI bubble in the infrastructure space and the data center space, in the venture space, a lot of companies, startups have been working on this stuff. And if you've even noticed that language models have improved, that agentic AI is now becoming more of a household word, and I think it's going to become more and more of a household, phrase. This tells you something about something that's happening underneath. There's a hum that you can hear underneath if you're very, very paying attention and very, very carefully paying attention. That's on the software side. It is improving. It is developing. And before you know it, it's going to be here in a reliable way. Let me give you another example. We talk about AI in the services sector because we sort of think about how is it going to help us during the day? How is it going to make the human more efficient? Let's talk about some hard sciences, like medicine. I guess medicine, if you take a scan of something, right? Somebody has a CT scan or an MRI. You can have AI read it and be able to detect things that the human eye cannot, right? I mean, that's a real boon to society in general. Maybe even be able to catch things a lot earlier if there is something that needs to be addressed. This has real implications for our lives. And this is where I say AI can be something incredible and definitely revolutionary. These things are slowly happening. It has the capacity to make a huge difference, especially in medicine at the moment that I'm hearing of right now. And I'm only one person, so I'm sure there's a lot more going on. But while we were worried about AI bubbles and data centers, a lot of people have been working very, very hard on the software side to create new things. That is true innovation here. So I am personally very, very excited. And it also excites me that you don't have to be a mega cap company in order to be able to do this, right? So that's what's happening in the venture space. So I think in about 3 to 5 years, we may be living in a very, very different world with different capabilities. So that gets me excited. So, market sell off in the last week or so, it's a blip. It's a natural thing. If there's some friction in a space that is brand new, like AI, as entrants come in, as market leaders retreat, this is all very painful but natural development. I wouldn't call this AI bubble popping. I would just call this something that's very healthy. In the long run, for something as revolutionary as AI, it's just a blip in the radar. So think long-term, be long-term investors. Last week, the Federal Reserve lowered interest rates by 25 basis points or 0.25%. It was pretty much priced into the market. Remember in the last several months leading up to last Wednesday, the markets were like, oh no, we have too many hawks. We're not going to get interest rate cuts. And then suddenly leading up to that date, a lot of doves showed up and were a little bit, worried about the labor market more so than potential inflation, and that got the markets excited, pricing in a 25 basis point cut for almost certainty, and it happened. The Fed cut. Now, the Fed did this without too much data. Because remember, the government was shut down. We didn't get the data about inflation or the job market for a while. And I wish the Fed had the numbers, especially the labor market numbers, to work with, but that's okay because I think at the end of the day, the Fed did the right thing. As you know, I'm a proponent of getting back to neutral. Now, so after the Fed decision, we got the jobs numbers. The jobs number came out and it wasn't great news. So I didn't think we were going to get numbers for October, but we did. Take it with a grain of salt. I don't know how accurate this is in terms of consistency from month to month, but it was negative 105,000 jobs. So net, we lost 105,000 jobs in October. Now, some of that has to do with the government shutdown. So again, a lot of noise in that data. November, we gained 64,000 jobs. I've said this before, but we really want the monthly net gains of jobs to be in the six figures. When it's in the five figures, once in a while dip is okay. But if it's in the five figures pretty consistently, that's not a good thing. And we've seen, for my taste, too many five-figure numbers in 2025 for me to feel good about the labor market. So that is on the non-farm payroll. The unemployment rate number came out. In September, it was 4.4%. In November, it ticked up to 4.6%. There are different views on this. Some of them, and part of what is driving this is a lot more people are coming into the labor market to look for jobs. So some people will say, well, it only ticked up because more people came in, so the pool is bigger. So of course the unemployment rate, if they don't have jobs, it's going to look bloated. Okay, but my question is, why are those people coming in to look for jobs at this time, right? Remember, before today or before this year, the equity markets went up. A lot of people made money in different things, including Bitcoin, including crypto, right? And of course, crypto has had a huge sell-off, etc., right? So people coming into the job market and participation rate going up is normally, outside of context, a good thing. We really want more labor in the United States because that's a sign of health. But contextually, in this context with the tariffs and everything that's been going on, all the data leading up to this month, I have to ask, why are they coming back? What are the reasons? Is it because they're running out of money? Is it because they're nervous? We have to ask these questions. So I'm not in the camp to say, no, it doesn't mean anything. It's not significant. I think there's enough doubt in that number to call that uptick not necessarily significant, but certainly something that should be paid attention to. Now, we don't have CPI yet. It's coming in tomorrow. And certainly the Fed had to make its decision before the inflation CPI number. But even though we didn't have the CPI yet, we did get some inflation-related numbers in the jobs number, which was wage growth. Came in at 3.5%, which is fine because CPI has been around 3%. So if wage growth is higher than inflation, that's where we want it to be, right? Because we want to grow our purchasing power. But contextually, again, a year ago, wage growth was at 4.2%. So we went from 4.2% this time last year to 3.5% this time this year. And that was the lowest since mid-2021 during the pandemic. So again, we have to ask ourselves contextually, what is going on, right? Now, Tomorrow, CPI is expected to be on the headline side 3.1%, up from 2.8%, and core CPI is expected to be 3.0%, up from 2.8%. Both numbers up. If that's how it comes out, then the Fed has an even more difficult job come January. I still think that they did the right thing, but I think they will be more torn if inflation continues to tick up or it is not heading in the direction of where their target is, which is 2%. 3% is not anywhere close to 2%. And 2%, in my opinion, is too low. I think we're living in a completely different regime than pre-pandemic when the Fed target was also at 2%. I don't think we're living in the same world. I do think that we're living in a higher inflationary world. But I mean, who knows? Who knows what the Fed will do? I'm not in the Fed. One thing that may help is that oil prices have been going down. But oil prices have been going down for the wrong reasons. It's because there's more supply than demand. And when oil demand is low, makes all of us question just how robust the global economy is. The growth of the global economy, when it's robust, there's a lot of demand for oil. But when there's lower demand for oil and supply is outpacing the demand, that usually is a sign of, well, why is there lower demand? Maybe things are slowing down. So all in all, there's a lot of stuff here. The Fed does have a difficult job. I mean, I don't want to poo-poo any of this because it is a hard task. And certainly if the CPI comes in a little bit higher than last time, they will have a difficult meeting in January, which also means then potential volatility for the equity markets and for the bond markets, because again, so much is riding on the Fed. It usually is this way. There was a time when it wasn't so much this way, but it is. So if the data are not pointing in one direction, like a definitive direction, I would expect there to be more equity market volatility. But in all, for the rest of December, maybe there will be a Santa Claus rally. I'm recording this on the 17th, so it's not Christmas yet, but we'll see. We still have a few weeks left in December in 2025. That's it for today. Have a wonderful week. I will be back next week. Thank you.